Hello, my name is Clive Cochrane and welcome to my YouTube channel, The Cochrane Codex. What I am building here at this channel is a reference resource, really, which would enable people who are interested in how the capital markets work, how various financial instruments work, the valuation of these instruments, the risks associated with them, and so on. In this video, I am going to look at asset swaps. An asset swap is a financial derivative package that allows an investor to separate the credit risk, typically of an asset like a bond, from its interest rate risk. The investor, let's say, buys a fixed rate bond and then simultaneously enters an interest rate swap to alter the cash flow profile of the asset. So essentially swapping the fixed coupon for a floating rate. But important to note, the investor retains the credit risk. So from a motivational point of view, let's say the investor fears that interest rates will be rising and holding the fixed rate bond is risky, subject to duration risk and so on, where the prices of the bonds will decline. By swapping the fixed coupons for a floating rate, the investor eliminates the interest rate sensitivity, but, as I just said, retains the credit risk exposure. Now, the asset swap spread, which I'm going to come on and explain, is the net floating rate spread the investor earns above whatever has been set as the benchmark floating rate. This spread reflects the synthetic credit risk of the bond issuer without exposure to the underlying interest rate movements, as discussed here. So in effect, what is happening is the investor is now holding a synthetic floating rate note issue as issued by the company in question or the bond issuer. So diagrammatically, we can see here at initiation, the asset swap buyer over here buys a bond for the full price, and let's say that is par. So the dealer, asset swap seller, let's say, has transferred the bond, which is currently at par, and the asset swap buyer, the investor, as I said on the previous slide, has now paid the par value, 100. Then also enters simultaneously an interest rate swap paying a fixed coupon C. So this is the bond here. The coupon is now being paid to the investor as of this part of the diagram. The coupon then flows through over to the asset swap seller, let's say the dealer or bank, and the dealer pays the benchmark rate, which in this case is SOFR, could be SONIA, plus S, which is the asset swap spread, which in some ways obviously will be a compensation for the dealer not taking on the credit risk. Now, if a default occurs, the asset swap buyer loses the coupon and the principal redemption value on the bond. But the interest rate swap will continue either until bond maturity, or it can be closed out at some definable market value. So down here, the issuer of the bond is defaulted, no redemption value, no further coupons, but the asset swap buyer is committed to paying across the coupon amount, even though not receiving it, and the asset swap seller, the dealer, is going to continue through the lifetime of this arrangement to pay the SOFR rate plus the swap spread, the S value there. So let's go through an example of how this might all work. A client is contemplating buying a 5-year bond with a 3% coupon, and that bond is currently priced at $97. Now, the client would rather not incur interest rate risk, but is comfortable with the credit risk. Client is confident about the creditworthiness of the issuer. The bank or dealer could provide a vanilla fixed for floating interest rate swap. But let's just complicate matters slightly and assume that the vanilla swap rate, in this case, for paying floating against SOFR is 2% versus SOFR. The customer would like to match the coupon income exactly, remember that's 3%, in return for floating receipts. Now, what could happen is that the bank could create an asset swap where the customer pays the 3% coupon and in return receives SOFR plus the asset swap spread, that's the element, if you like, for the credit risk issue, and a further 100 basis points to deal with the fact that the customer is paying 3% and the dealer is only paying 2%. Customizing the asset swap will involve matching coupon dates to the swap payment dates and matching, say, the maturity of the swap with the maturity of the bond and so on. So this will require a certain amount of financial engineering on the part of the bank or dealer that's going to enter the swap. Now, also assume for tax reasons that the client wants to pay and receive par on the bond. The bank or the dealer can customize the asset swap by accepting an upfront payment of 300 basis points. You recall that the bond is actually only worth $97 in the market, not par, and then the dealer could provide a par asset swap. To compensate for the receipt of the upfront payment, the bank adjusts the floating leg by using, for example, an annuity calculation over the 5-year period with the 100 BPS plus the ASW spread that we saw on the last slide and this additional approximately, let's say, 60 basis points based on this annuity calculation. We need to recall that the customer is still subject to credit risk. Now we can see diagrammatically what this involves, the two examples I just went through. So we now have the investor paying $97, receiving this 5-year bond with a 3% coupon, and which priced at $97. At the end of the bond's lifetime, the bond will redeem at par, so the investor after 5 years will receive the $100 par amount. And you remember the investor is going to pay the 3% across. So this essentially is the dealer. The asset swap in its pure vanilla form, where the current rate, say, on receiving SOFR and paying out fixed is 2% against SOFR. So now we can see that the adjusted cash flow from the dealer is the SOFR plus the ASW plus the 100 basis points to compensate for the 3% versus the 2%. Now, if we go to the slightly more elaborate example, this is where the dealer is going to create a par asset swap. So once again, we have basically the same items over here, but bear in mind now, the investor is going to pay an upfront 300 basis points to the dealer, and that way the dealer will then redeem at par or pay out par at the end of the bond's lifetime. The 3% still being paid. We still have the 2% against SOFR as the sort of vanilla swap payment. But we now, in terms of the and combining all of these ideas, we now have this payment from the dealer of the SOFR plus the asset swap spread. In this case, plus the 100 plus the further 60 basis points to compensate for the original or initial upfront 300 basis point payment by the investor. One final point I want to make is to contrast between an asset swap spread and a credit default swap spread, because obviously there is some similarity in the sense that credit risk becomes involved in both of these particular types of derivative. An ASW spread is a funded measure. It's funded in the manner that we've just gone through with the last diagram. The ASW spread represents the synthetic credit spread of a specific bond. The ASW spread incorporates not only issuer credit risk, but also bond-specific factors like liquidity and pull-to-par effects and so on. On the other hand, the CDS spread is an unfunded derivative. It's a contingent item. It resembles an insurance contract. The protection buyer pays a periodic fee, the CDS spread, to the protection seller. If the underlying reference entity, a bond, let's say, defaults or experiences a credit event, the seller compensates the buyer for the loss. So as you can see, there is quite an important difference between the two, even though in some ways they are both involved in a calculation or estimate as to credit risk. So I hope very much that you enjoyed that video and found it interesting and useful. If you find this type of material to be of value to you, where I analyze critical ideas and episodes in the world of global finance, could I strongly suggest that you decide to subscribe to this channel. Thanks very much for watching.